Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Be sure to subscribe to our recently launched Substack, the Planet MicroCap newsletter, for free at microcapnewsletter.substack.com. I'll be sharing all recent podcast episodes from Planet MicroCap and due diligence on there. Plus, every Sunday, I put out our weekly MicroCap wrap to show how the MicroCap space has performed compared to the broader markets based on data from the MicroCap Review Index. Again, to subscribe, please go to microcapnewsletter.substack.com. Now, for this episode of the Planet MicroCap podcast, I spoke with Ryan Reeves, founder of Infuse Asset Management and CIO of Infuse Partners LP. I'd been wanting to chat with Ryan on here for a while, but we just couldn't figure out a time. And I got an email from him a couple of weeks ago announcing the launch of his public equity fund, Infuse Partners LP. I asked him to come on to the show and we made it happen. We talked about everything from when he got his start investing, his research as a service platform, Investing City, how he got the Walmart CEO as his first guest on his podcast, and of course, his new venture. My favorite part of our interview is why he waited to launch a fund until he experienced a market drawdown. Thank you again for tuning in to episode 236 of the Planet MicroCap podcast, and please enjoy my conversation with Ryan Reeves. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back to the Planet MicroCap podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is someone, it's Ryan Reeves. He is the founder of Infuse Asset Management and CIO of Infuse Partners LP. And I was going to preface that because I've been a fan of Ryan's. It's got a great this amazing podcast at Investing City, got some amazing guests on there. Really one of the up and comers in investing. And I think we had planned to do this a while ago, but what better time is now? You're launching a fund. So with that, Ryan, thank you so much for joining me today.
Thank you so much for having me. That's far too kind.
Look, dude, I mean, you've come a long way, right? How old are you now? You're mid-20s?
Yeah, I'm 25.
It's pretty amazing that you've been able to, since launching Investing City, and we'll get into some of your career as well and what got you to this point, and just now making that jump to launch your own fund. So let's start there. Let's start from the beginning. Where did your passion for investing begin?
Yeah, so I was a really nerdy kid. I actually bought my first stock at 12 years old. It was very random, but I had a fifth grade teacher who, her husband was actually very passionate about investing. And this teacher invited her husband to come in after class and just explain, stocks and investing to kids who wanted to stay. And there was like a couple of us, right? What fifth grader would want to stay after school to learn about something boring like finance and stocks? But for some reason, I stayed, and we did this little competition where you pick a stock and see how it does over the course of the year. And most people do this when they're seniors in high school in economics or whatever. But I did it in the fifth grade, and I picked McDonald's just because I thought that was very a lot of people go there, and there's always a line or whatever. And the stock didn't really do that great. And this girl, one of the few others that was in the group, she picked Apple and absolutely crushed me. And I was like, wait, why did that happen? And I was just so confused about the whole thing and how it all worked. And I just started going down the rabbit hole and bought my first actual stock, which was Corning Glassware, because I heard that they were making the Gorilla Glass for the iPhones, and I should have just picked Apple. I was already thinking too in the weeds, but that's a little bit of the genesis. And I just love that investing is really just this intersection of so many different disciplines, business, finance, psychology, economics, history, and just figuring out, I view it as like this big puzzle, and it's just a never ending puzzle that you can continually get better at within your own psyche. And there's endless number of businesses to analyze. And so there's always something to do, always a way to improve. And I just really like that idea of constantly improving, and just this idea that it's a big game and a big puzzle. Obviously, there's very real repercussions with, our wealth and trying to grow it and make a better life for ourselves. But I also just view it as just very intellectually stimulating.
Do you remember at that time, I'm taking you back to when you were, what was fifth grade? What was that? You were 11 years old, right?
Yeah.
By the way, quick side note, my dad tried, he was a former investment banker for over 30 years on Wall Street. He tried to do the same thing in my fifth grade class, but because it was my father, I was like, I don't want to freaking do this, right. But I wish I did listen, but side story.
I'm sure I did the same way.
Yeah, right. But take me back to when during that time, and you saw like your friend crushed you, pick an Apple, you pick McDonald's. What was it that you learned during that time, maybe that you kept with you, that you're like, oh, that's why I lost? Or did it just happen to be timing?
Yeah, that's a great question, actually. First of all, a bit of it was just Apple was growing very fast, like way faster than McDonald's. And so it's interesting, some of our initial experiences of how that kind of, biases us, maybe is a negative word, but, how it influences us. And, I tend to look for companies that are, very fast growing, and, maybe that's one reason, maybe it's not, but Apple, when I started actually looking at the numbers and figuring out that there was more than just, the Peter Lynch idea that you should, always be observing the world around you, that really resonated with me. But actually looking at the numbers to back up, you could just have like a very active community that is always at this particular store, but you need to be able to look at the financials and see, if really look at the evidence and see if things are there. And just that's something that off the top of my head, Apple was growing so much faster. They're really getting into, the iPhone launched in, late 2007. This is around 2011, 2012. And so they're really coming out of the great financial crisis, and the iPhone is really ramping up. And so it was really just this confluence of a lot of different aspects. But I'd say the number one thing that maybe is a takeaway is just they were growing really fast and actually accelerating that growth.
Absolutely. Very good. All right. So now catch us up. So, all right, you're hooked, you're in starting fifth grade. Now, even prior to the launch of the fund, which I think is supposed to launch August 1st, right?
Correct.
Okay, cool. All right. So we're putting this out. People should be listening. It's going to be August 4th. So, go give him a holler, see what he's got going on there. But before launching the fund, catch us up. What did you do where you knew like, okay, I want to be in investing, I want to be in finance, that's my path. Where did you go from there?
Yeah, it's a great question. So Going to college, I originally was very set on starting my own business. I mean, I just being interested in investing since I was 12. I knew I wanted to do something with business, and I thought that really business is, if you can't invest without business, and so you need to know business before like understanding really investing. And I also just thought that, like from a perspective of investing, just looking at these numbers on a screen all day, is that like the most fulfilling thing? Like, is that what I want to spend my entire life doing? And so I thought that like business and really serving people in that capacity would be, much more fulfilling. And it's been a really long journey, but I've just kept coming back to investing over and over again. It's just my passion. I just really love it. And I mean, it feels like complete play, I feel like I haven't worked in the past 5 years at all. And so going into college, I really just kept coming back to the same idea. And so I was like, what if I just start a business about investing? It's like you can have the best of both worlds. And I was like, I graduated a little bit early, and my long-term goal was, how can I do investing for a living? And the way that I saw that over and over again was a fund. And it's like, okay, so maybe I'll just start a fund out of school. But there was really two problems with this. One, I was had just turned 21 years old. Who in their right mind is going to trust a freshly minted 21-year-old with their hard-earned money? So that's one aspect. And number two is I started investing right at the end of the great financial crisis. And so there was a lot of little pullbacks, like 2011, there was like bunch of SaaS crashes over that period. There was the COVID, drawdown, but I really hadn't experienced like a really gut-wrenching drawdown. And I thought that it would be prudent for me to actually experience one of these and test myself rather than, just saying, you should trust me just because I really enjoy doing this. I had built a track record for like 10 years now. And I thought, I was pretty confident in my abilities, but also I didn't want to just test it out with other people's money and just see how it would go. That just didn't feel very responsible to me. But, now in the past 7-8 months, it really has been a gut-wrenching drawdown. And I feel like I've kept my composure pretty well. And so now that those two things, it's been 4 years since starting Investing City, and that was just a little bit getting back to the genesis. I knew I wanted to start a fund, but there were these two problems. So how do you solve these two problems? And one was, how about if I show people rather than tell people? And that was the genesis of Investing City, and just putting out my research as publicly as possible, and actually built a sustainable business by just doing that. And that's kind of how I've parlayed that into doing this fund. And so, yeah, Investing City was really a way to just build track record, build evidence, and just show people that I have what it takes to be a good investor. And so that's a little bit of the genesis, and here we are, almost at August 1st.
Man, you must have some great parents, I got to tell you, because wow, I'm a little speechless, only because like that is one of the most refreshing things I think I've heard from younger up and coming fund manager investor saying, I don't want to. Okay, I might be doing well now, but we've been in a 10, 11-year bull market. I haven't really been tested. Like, it's funny. There's a few of investors that we both know well, that always say like, "Hey, you've been in the middle of this. Like, wait till you get a first drawdown." It's really amazing that you kind of thought to yourself, like, I don't want to launch a fund until like I need some pain. Like, I need to feel some hurt. Like, where does that come from?
So yeah, speaking to parents, I do have a set of amazing parents who really just instilled core values from day one, and really just this idea of thinking about others rather than yourself. Also, my faith is a big aspect of that. I mean, there's various Bible verses talking about put others above yourself. And so it just, especially in, like the world of money, it's just always thinking about, how can I get more? But that's just really not fulfilling at the end of the day. I mean, you hear story after story of very wealthy people who are just alone, and because they haven't really served others. And so that's really the counterintuitive way of the world is serving others is really like the way to happiness, if you want to call it that. But honestly, my parents have just really been a stabilizing force in my life. And so I'd say definitely those two things. Thank you for asking that.
No, I want to really, I really want to highlight that. I think that's really an important part of your story. And again, just really refreshing. And so I hope if there's anything that people take away from this interview and flag, it's that part that, you wanted to feel the pain, before, going out there and investing other people's money at the end of the day. But I have one question on Investing City, because I have to ask. I remember when you first launched it, how the heck did you get the CEO of Walmart as your first? I mean, come on, man.
So it's actually not
tricks of the trade.
It's not impressive. One of my best buddies from college, that's actually his dad. So I had been over there. So they live in Arkansas. I've been over there multiple times, and this is one of my really good friends. And so he did me a favor. He did not have to do that. He has so many better things going on, but he was nice enough to spend a little time doing that. So I'm really grateful.
I mean, that's clutch. I mean, even if it's a best friend, that's still an ask, right? I mean,
yeah, that's true.
Oh, that's good stuff. Oh, that's awesome. So another question that I have for you, hold on. I wasn't expecting that. That's really funny. That's so funny.
Yeah, I wish it was a better story of I hand wrote a note to him and did all these things. But he's just a really, really nice guy.
That's awesome. All right. So, before we get into the launch of the fund and then actually going there and philosophy around that, what were some of your biggest lessons learned from running Investing City and having this, you called it research as a service. What were some of the biggest lessons that you learned?
Yeah, it's a great question. I think one of the biggest takeaways is, just handling people's emotions, and how communication is so important for that. And so I've really tried to default to transparency. And I think people have really appreciated that. Like a question I get kind of frequently is, how, especially during these, past 7 months, how has it been? I'm sure it's just been a pain because people are always reaching out and really nervous. But honestly, it really hasn't been bad at all, because I think there's this idea of self-selection, and the way that you kind of put yourself out there and the way that you talk about things and even lay out your strategy, people can self-select into that. So if, I'm chasing different stocks and I'm just posting charts, no fundamentals, and I'm talking about a short-term time horizon, then people will self-select into that because of how I'm talking about things. But if you're really intentional about being upfront about this is a long-term strategy, and here's how I think about things, and just being transparent from day one, I think that you get a certain type of person that you kind of deserve. I mean, Buffett talks about that with the spouse. You have to be the type of spouse that you want in order to get that spouse that you want. And so there's really this aspect of communication and transparency that I think is a big takeaway, especially if we're going into a fund, and how you're talking about things. So even in the slide deck with my fund, I have a slide that says this fund isn't right for you if. And so I'm essentially slicing off a large piece of, the general population that might want to invest in this fund, but that's totally fine to me, because if you're all things to all people, then you're really nothing to anybody. And so I have a, particular strategy, and people that, are obsessively focused on the macro and, very short-term time horizon, not focused on fundamentals. That's totally fine, but that's just not the type of person that I want to attract, because I want that type of person to be highly aligned with my strategy, rather than the short-term results.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. Very good. All right. So let's get to the fun and the launch of it. So you're going to laugh when I ask you this. All right. Why did you decide to start a fund versus, maybe just having a Substack and just, charge a subscription fee and, putting out a pick a month or something like that? Why go this route?
Sure. So it's a super valid question. And one thing is that I just love the craft of investing. And to a certain extent, running a newsletter is really a content business. Like it's competitive out there, and you're constantly having to think of, new ways to market and retain subscribers. And if you're not pumping out content on a weekly basis, it's fairly tough to retain clients.
In fairness, you're a good marketer though. I mean, yeah, you built up a nice following on Twitter. Yeah, I'm sure you got some good guests on the pod. So in fairness, you're pretty good at that.
So yeah, well, I appreciate that. So one other thing is that I also, from the very beginning, I had really had this vision of two sides to the business. So one is for people who are, you want to do the investing on their own. They're just looking for a little bit of research and a little bit of direction. And then other people that I just got time and time again, a response of, this is great, this whole investing city thing, but I really just don't want to spend, all of my waking hours, researching stocks because I'm just frankly not as passionate about it as you are. And so I thought it would be amazing if you could have two sides of these business, two sides of an investing business where you have the content and the ability to give self-directed investors some research. And then also for the people who don't want to do it on their own, you could have a fund. And so that's been my vision from early on. And I want to ideally run both sides of the business as long as possible. I know that there's regulation. You have to be really clear about different things, but ideally I could provide, a very low cost service to self-directed investors, and then a little bit of a higher touch, premium service for investors that really just don't want to do it themselves.
Very good. All right. Let's get into the fund itself. What would you say is Infuse's philosophy?
Sure. So the way I think about it is the little tagline is we're trying to invest in the fastest growing, highest quality companies at the best valuations we can find. And so that's very intentional, even the ordering of those things. So I'm really looking for first companies that are growing very fast. And that's because if you have fast growth, then you really have some compelling product or service, some tailwind. You're doing something different from competitors, or else people wouldn't be buying your stuff. Like you can think of revenue as being broken down into a very simple equation: price times quantity. And so you're either able to charge a higher price, you can raise your prices. Pricing power shows that you have a product or service that doesn't really have many substitutes. Or you're selling a way higher quantity, and that implies that you have a very scalable model, or you're doing something for lower cost, or just something that's interesting, right? But if you do that, like without any ability to print cash, then it's not actually that exciting. And so that's where the quality piece comes into it, because anybody can sell a dollar bill for 90 cents and you're not actually making any money. And so that's not really that impressive. And so really the first filter that companies go through in my process is this company growing, faster, like very, top decile of companies in the universe I'm looking at. And then are they exhibiting very strong incremental margins? And so those are really the two things. I want, that revenue falling down to the bottom line, because that implies to me that there's really efficient execution. And so if you have demand coupled with execution, the output of that is really strong earnings growth. And that's really what drives stock prices. And so if you can find companies that are growing their earnings really fast at reasonable valuations, that's the holy grail of investing. Usually, it doesn't all line up. Usually if you find a company that's growing really fast, incredibly high quality, the valuation is usually super high. And so really these three legs, you're ending up having to compromise a little bit on one of them. Ideally that's not the case, but valuation is the one that I end up compromising on the most relative to the three. I certainly, valuation is important in my process. But, if you have a very high quality business that is hopefully compounding for years and years and years, the valuation as long as you don't pay outrageous multiples, tends to take care of itself a little bit. You don't want to bet on multiple expansion, certainly. And so in my process, I'm, most of the time betting on multiple contraction. But that's really the core, the outline of the philosophy. And so I'm not necessarily, all in tech, which tech to me is kind of like this superfluous word. I mean, back in the day, railroads were tech. Tech is just anything that allows people to do more with less. And so it'll have various functions and forms over the years. But it kind of ends up being more tech because that's where a lot of the tailwinds are. And, as long as, companies are innovating, then people buy those products because it's making their lives, easier, whether it's lower costs or saves them time. So it ends up being a lot of tech stuff. But those are the core theses: the fast growth, high quality, and quality really goes into like longevity. I mean, if you can grow for, a year, that's great. But if you can grow for, 10, 20 years, that is so much more important. And then there's so many dynamics of quality, this management team, the market structure, competition, if the company is attracting the best talent. So there's so many dynamics of quality that's, by definition, the most qualitative input to the process. So yeah, that's kind of a broad outline.
Absolutely. So let's dig into fast growth and high quality a little bit. So on the fast growth side, what is that metric that you're looking for? What does fast growth really mean to you?
Sure. So I have a big database that I've built over, the 10 years of investing that, has hundreds of companies. And so I basically sort those by growth. And so fast growth to me, it's very subjective depending on, people's filters, how many stocks they own. But fast growth to me is like 50% revenue growth. And obviously, if companies' gross profit margins are just absolutely deteriorating and gross profit is only growing 20%, if revenue is growing 50%, then, that's a problem. And so I also look at gross profit growth. And so it's nothing super fancy of just looking at companies and ideally it's accelerating. So, it's one thing to go from 100% growth down to 50% growth. It's another to go from 40 to 50. And so one implies that there's some deceleration going on in the business, whether a competitor is coming in because, it's such a hot space that there's so many competitors coming in. And the other, it could be the case that they launched a new product, a competitor actually fell out of the market. And so it's really context dependent. Investing would be super easy if you just, looked at a screener and said fastest growth, and you get, like 1,000% growth because some biotech, had a new product hit, or like Zoom during the pandemic, or like it's not super sustainable to almost grow 400%. So it's very context dependent, but that's generally a ballpark that I'm kind of playing in.
Very good. Yeah, no, I wanted to get some context around that because you hear like, oh, we're looking for fast growth and all that all the time, right? So we want to better understand, okay, well, what does that mean? Like, what does that percentage actually look? And then of course over what time frame as well, right? So yeah. No, you're
exactly, because you could have a very sleepy company that is growing 5%. All of a sudden it shoots up to 50, and you're like, oh my gosh, what happened? Maybe they just acquired a company, and so you have to assess the company that they acquired and that growth, or maybe there's some some event that happens that isn't necessarily sustainable. And so it's not a purely quantitative thing. It's just the quantitative gets me in the ballpark that I can start to do the qualitative research and make sure I understand how quality is this growth. But, company that, is not growing at all would be just an easy filter out, because that's the thing. There's thousands and thousands of companies. How do you have filters that allow you to best focus your time? Because it's just very and ideally you can go through every single company, but there's certain companies that you can just screen out immediately because it doesn't quite fit your style. And so it's really just a way of filtering down the universe so that I can best spend my time.
Very good. All right. So now let's dig into quality. Before I ask about that, I mean, where does your universe of investable ideas tend to live? Are we talking small, micro, mid? Where are we looking at?
Yeah. So honestly, I don't even think about market cap that much. I ideally, just as long as it kind of fits my criteria. Like one thing is, so I tend to not play in the super small stuff because like there can be very high quality companies in the microcap space. You obviously know that, but it tends to be like
By the
they
way,
just
whatever you're about to say, it won't offend me. So go.
no, I'm not even trying to
No,
dance around anything.
I'm just giving you. I'm giving you a hard time.
But that's all to say. Like, as long as it fits the criteria, I'm totally fine. It's just most of the companies that I'm looking at tend to be at least $1 billion. I've definitely found companies that have started very small. There's been tons of examples, but they generally above $1 billion in terms of market cap. And then I generally don't really go above like 150 billion. That's kind of a place, but it's that's incredibly wide range. Like ideally I'm trying to
Sure.
find between like a small to mid cap company that is becoming on its way to a very large cap company. But that I basically trying to say I look at everything as long as it fits the criteria.
Very good. And then okay, so getting on to quality, I mean, what are some of your qualitative metrics that you tend to look at? I mean, if the universe ends up being 1 billion and above, then maybe you could get in touch with management. It's sometimes a little bit difficult, but so how do you evaluate the business then from a qualitative perspective in this universe?
Yeah, so this is the fun part of really just acting like an investigative journalist and trying to figure out all your questions about a business. So doing the basics, you're reading all the filings, reading all the transcripts, assessing different competitors, maybe talking to employees of those competitors, just trying to understand really at the core. The way I think about the qualitative piece is value capture and value creation. And so if you can create a lot of value, that is, the key to business. If you're adding value to people's lives, then they won't help but buy whatever you're selling because it makes their life easier. Like we're pretty self-interested beings at the end of the day. And so if you can help people, save time, save money, then you will likely grow. And so that's the value creation piece. If you're constantly creating value and the trajectory of that value has to be growing. Like a lot of people talk about the very wide moat companies that basically they're charging incredibly high prices because customers like can't really do anything about it. So that's not really the type of company that I'm looking for because to me, the moat actually in the very long term is a little bit more fragile. As long as capitalism exists, people are trying to come and eat those margins. And so I would rather have a company that is really on a strong trajectory of creating more value, because if you can create more and more value, then it's pretty hard to disrupt that. Because it's embedded in the culture or whatever, and so then you can create a lot of value, but if you don't capture that value, then that's a whole nother thing. Because if you can't actually capture any of the value you create, then there's probably a lot of substitutes, or there's something that's replicable in your business. And so those are really two of the things that I think about deeply, and so that really involves a deep study of competition, and so that's one thing that I really try to hone in on and try to, if there's a lot of public competitors, you can read all the 10Ks, read all the transcripts for those competitors as well. And so I really want to even know the competitors, like, not maybe to the extent of the main company, but, very, very well. And then also just, classic things like management, listen to every single interview by the management that's out there. And actually, this might be a little bit controversial, but I actually tried not to speak with management. That's just something that I know it's kind of out there, but I think that it actually, in my experience, has biased my view quite a bit. Because leaders of companies, they're incredibly charismatic. They know how to lead people, and I just noticed myself getting caught up in what they're saying and how they're saying it, rather than lining up all of the facts and figures. So that should just be one input, but that really outweighs all the other factors when I tend to speak with management. So that's not to say that I don't listen to absolutely everything that management says. So there's a difference. But actually speaking to them, I want to be liked by them, and don't really ask them the hard hitting questions. And that's just kind of my personality that I found that doesn't necessarily work for me. That's not to say that would always be the case, even for myself. And I know that that's a huge piece in most investors' processes. But that's actually something that I don't place a high value on. To me, just how they think in general is really important, and then also skin in the game. Like money talks to me, and so I would rather have somebody that has huge skin in the game who isn't the most charismatic than somebody who's always trying to sell the business and sell themselves but doesn't own any skin in the game. So I spend a lot of time thinking about incentives and how management is thinking about the future. But yeah, basically I'm rambling at this point. Like quality, there's so many pieces to it that it's hard to define explicitly, but you generally start seeing that show up in margins. And so if you kind of want a shortcut, looking at incremental margins can tell you a ton about the quality of the business in terms of the operating efficiency. But then there's also the quality of the value creation. And so I really think about the value creation as tied to revenue. And then the value capture is kind of tied to margins. And if you can really get those things dialed, then the earnings growth will be very strong. And so really thinking about those two dynamics a lot, and really just going down the rabbit hole. If you have questions, how much more, going back to the revenue equals price times quantity, how is this business set up to sell more of the product or service, and how are they set up to sell it at a higher price? And so really just going into all the questions that those two things deserve, and the answers to them. So quality is an elusive thing, but you really just get this idea after going down the rabbit hole of trying to answer those questions.
For sure. Sorry, I just had this vision also of you saying, yeah, I don't want to talk to me. And then like 10 years down the road, you're just like a grizzled vet, just like not caring, just like, why didn't you hit quarterly expectations, on this? Like, that would just be kind of hilarious. And like, you do this again at that point and be like, yeah, no, I now talk to management like every single time. I ask like 10 questions on every conference call.
Maybe I'm super open to having my mind changed.
Very good. So in terms of some experiences, not asking for specific stocks or anything like, but if you want to share, of course. And you mentioned how this recent drawdown, you wanted to experience that. You wanted to understand what you were going through and how it tested your thesis and your investing philosophy. So, I mean, do you have any examples from that where you're like, wow, I don't know, you tell me like some of the lessons you learned from that, maybe from that specific investing experience.
Sure. So, I mean, just the interesting thing about the past couple of years is how many different market dynamics there have really been. I mean, during COVID, there was a fairly large drawdown, and then kind of the government backstopped a bit, and now we're seeing liquidity get sucked out of the system. And so one thing that I think is kind of obvious but really important is just the simplicity of being free cash flow positive. You can control your destiny. So, there was definitely some companies that, they were getting progressively more and more profitable, but they were still, compared to competitors, just not nearly as strong on the bottom line. And, that's great and all when, the liquidity is flowing, but as soon as things start to get a little bit dicier, then you want companies that will be able to control their destiny. And you can control your destiny if you have a strong balance sheet and you're able to gush cash. And so, frankly, that you just put yourself into a much stronger position. And so there were a few companies that I invested in kind of last year where, they're still really strong companies, but to a certain extent, they're not able to continually like get as much value captured from the customers because, maybe they're undercutting a competitor or just not really able to control their destiny in the same way. And so I think that's one takeaway just from this drawdown, that if you have companies that you're buying at reasonable valuations, they're, gushing cash, then it's all fine because if the valuation goes down, they can buy back their stock. They can incentivize, the best employees that, leave competitors because they can't pay them as much. And so I really think that being able to control your own destiny in all periods and not getting, undisciplined in the sense of, looking at that growth. But yeah, it has to be both of those, the growth and the operating leverage coupled together.
Absolutely. And what's your ideal time horizon when you're looking at potential investment?
Yeah, so ideal is as long as possible, but it generally ends up being between like 3 and 5 years. So not like incredibly long, but it also depends because just in the arena that I typically am playing with, things are quite honestly changing, more rapidly than if you were looking at a pretty low growth sector. And so, it's different when you're looking at, software versus trash companies, like they just not nearly as many competitors are coming in and trying to steal your trash business. And so, those boring businesses can be really amazing and, huge compounders. But if you're playing in a sector that, is growing fast and there's decent amount of competitors that are coming in, quite honestly, it's not a, buy and forget. If you buy a software company, depending on the one it is, then, ideally you'd want to hold it for as long as possible. Economies of scale kick in, switching costs, network effects, all those good things. But, frankly, the barriers to entry simply aren't as high. And so you have to stay on top of the different competitive dynamics. And so if, something shifts and I see a competitor that's much, much stronger and important employees are leaving business and they have a few bad quarters, I'm quite honestly not afraid to change my mind if I feel like the thesis has changed. But ideally, I'm holding companies for as long as possible.
Very good. And another question I have for you is, you've been kind of on your own, you've been on your own, investing your own money for, the last 10 years. Now you're launching the fund. Did your philosophy or your strategy change at all now that you've launched this fund, you're doing this route now? Did you have to rethink how you wanted to invest as a result of wanting to launch this fund, or have you kind of just been building to this point?
I think more building to this point. Like the way I thought about it was, if I'm doing things for other people, to maybe smooth out volatility or, make it look better from the outside, then I'm inherently doing something that I'm not quite comfortable with because I haven't been doing that for, the past decade. And so I actually thought of that as potentially adding more risk into the equation because start doing something, like playing with leverage when I've never done that, or I'm just doing something to really make it seem like, better to the outside or whatever. So it really has kind of been building to this point, but I've spent a lot of time thinking about how to relay the message and just what is in common with my strategy, just because, I want people to understand and really be aligned with the types of companies that I'm looking at.
Very good. Okay. All right. We kind of talked about, an investing experience from this recent drawdown. What was an investing experience from leading up to, let's say, March 2020 that really you'd say you took a lot from? Whether it was a win or a loss, but it just really influenced your thought process.
Yeah, that's a great question. So I think one thing that really influenced my thinking was just actually studying Shopify really in depth when it IPO'd. So IPO'd under $2 billion market cap. And not really much fanfare, kind of this Canadian company. People in tech definitely knew Shopify. If you knew somebody who had the little e-commerce store, they definitely knew about Shopify because the offering was really strong. It had really high quality VCs like Bessemer. And so studying this company, and people thought that it traded for a ridiculous sales multiple. And I did too, actually. But it was growing 100%, and margins were continuing to get better. They were kind of running the business at break even, and the merchant solutions business was really ramping up. Until then, they had pretty much been a subscription only business model. Gross margins were like mid 80%. It was clear that it could be a very profitable business. But what's happening is they're ramping up their payments business, and it was bringing down gross margins a ton, and profitability was kind of getting masked. So there was these dynamics that made the business look, from like a quick glance, high sales multiple, the gross margins are going down, really not that interesting. But as you really dug in, just it became more and more apparent that the quality of the business was very, very interesting, and the CEO was highly incentivized. And so I think that this is not a mind-blowing lesson or anything, but when a company has proven that it can have operating leverage and it's growing 100%, pay attention. Like, it is not simple to double your business wherever you are. Whether you're small, whether you're big, any company that is doubling their business means that, like, either A, they have the same number of employees and those employees' capabilities have to get twice as strong every year, or B, they're hiring twice as many people, or obviously it's a mixture of both. But being able to scale an organization that quickly and being able to do it efficiently is something that is very, very hard to do. And so that's not really a mind-blowing conclusion. But if you have operating leverage and you see a company doubling its revenue, just really pay attention.
That's great stuff. All right. Close us out here today. I mean, what advice do you have for folks maybe that are similar to yourself that either, you at one point were just getting your start, but let's say they're on that path or a couple of years in as a, DIY investor doing their own thing, running their own book, but with eventually dream of launching their own fund. What advice do you have for folks that hope to get there one day?
Yeah. So I would say that there's really two things that matter. Passion, that you really love this, because there's so many people out there that love this game. If you don't love it, it'll be pretty hard to do the necessary work that is required to excel at it, just because there's so many people out there that really enjoy it. So passion, just make sure it's there. Like, I'd say one thing, it's probably there if you're spending like your Friday night setting a company. Not to sound like depressing or like you shouldn't have a life, but if you just find yourself thinking about stocks or really looking forward to digging into a company, then the passion might be there. And then you kind of have to nurture that. It's not like I was as passionate about investing as I am now right at the beginning. There's certain things that you just have to do a little bit more, and that passion might grow. And so just thinking about, like, almost at the meta level, like, where's the trajectory of my passion? And then number two is show your work. And so if you love investing and you just can't wait to do it in the morning, just show your work. Because if you build up enough goodwill over time, like, goes back to value creation. If you're adding value to other people's lives, maybe you're doing like incredible research on some subsector that you really enjoy, and that, like, you become kind of an authority on that, or you're just looking at so many businesses and putting it out there that people can get an idea of the business and then go deeper themselves if they want to. Basically just show your work, because you can have this whole library of stuff that you want to do yourself, and that's totally great. And maybe you're just a self-directed investor who wants to stay private, and that's one thing. But if you do want to start a fund one day, then it probably just makes sense to start getting that goodwill and showing your work and adding value to people as much as possible. The number one thing I would say is add value. Don't even worry about anything else for like at least 2 years. Like, don't even ask for anything. It's really just this idea of adding more and more value every single day, and then eventually things kind of come back to you. So, like, don't even worry about capturing that value for a long time.
Very cool. All right, Ryan, I think we're there, man. Where can our audience go and find more information about you, about Infuse Asset Management, everything they need to know to follow along and get more information?
Sure. So I'd probably say my Twitter account is a good place to start. So that's Ryan Reeves with an underscore right at the end. So if you go there, you can find a little link where it has branches out all to Infuse and Investing City and podcasts. And so you can find everything on my Twitter.
Very good, man. All right. Well, Ryan, this has been an absolute pleasure. Thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update. And congrats.
Thank you so much. No, I really appreciate it. Thank you so much for the questions.
Absolutely. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.